moving on to one stock in particular we're watching. Shares of Netflix are climbing this morning. Bloomberg has learned that the company may acquire the streaming rights to DreamWorks movies. John is back with us on this possible deal.
The one stock that can't take a hit. Yeah, this stock's now up about 60% this year. Bloomberg reported over the weekend that Netflix is talking to DreamWorks Animation about a deal where it would acquire the streaming rights. Of course, these days we're not really talking about Netflix, the DVD mail part of the business anymore. We're talking about getting all the rights so they can stream right into your home, and that's encouraged investors this morning. They already have a deal, DreamWorks, with Time Warner's HBO,
right.
But there's talk that maybe they would break up that deal and get a new one. We know for Netflix, they've been on a tear and they need all the content they can get. And for DreamWorks, by the way, they've had their own woes, so they're looking to perhaps find something that will get investors excited as well.
Okay, I want to stay on Netflix, and I want to bring in Lazard Capital Markets senior analyst Barton Crockett with us. He has a neutral rating, right, on Netflix, and of course Kevin's staying with us as well throughout the rest of this program. Barton, what do you make of a move like this from Netflix?
Okay, well, what Netflix is trying to do is lock up as much content as they can for their online streaming. They see at DreamWorks an opportunity. This is a company that has, taken some hits because of their exposure in the DVD market, which is the main driver of earnings for them. Mm-hmm. The only way that they can get rights, more money to replace kind of the shortfall in DVDs is to get more money out of streaming. So to do that, they have to do a deal with Netflix because they're writing the checks right now. In order for them to do a deal with Netflix, they have to exit their HBO deal because HBO owns the online streaming rights. So what you see with DreamWorks is really their attempt to address the most important issue for them. And for Netflix on their side, they've got challenges with content, right? So they've bought a lot of rights, but some of that's coming back. So they have more competition, out of Amazon buying rights for CBS content. Netflix is losing some of the recency of content. So they have Saturday Night Live. They've lost the current episodes in their recent NBC renewal. Mm-hmm. And then they've got to deal with Liberty Stars, which is going to be up for renewal in the first quarter, where they get a lot of Disney content right now. DreamWorks is a hedge on that. If that doesn't work out how they want, they've got some DreamWorks content. So Netflix is working hard, I think, to keep the content strong in an increasingly competitive environment.
Because they need to also justify this recent pricing change that they've made to customers.
Yes. I mean, Netflix is, they're moving in so many directions at once, it's hard to keep up with it. But they have basically, bumped the price 60% for the DVD and streaming combination. And, at the same time, you're changing the content lineup. There's a lot of, I think, execution risk for a stock at a 64 PE.
I was going to ask, preface this by saying you're neutral and I'm a value investor.
Right.
But what is the valuation metrics that people are using to justify this price?
Well, with Netflix, you have to look out and say, how many subscribers do you think they will have? What's the present value of that? You've got to look at the U.S. and you've got to look internationally. I mean, the way I value it, I would say that investors today are buying a stock where you're saying that over 90% of all broadband subscribers in the U.S. will have Netflix, which is a very high threshold. Mm. They're launching in Latin America, which they'll be talking about on the call tonight. There's, a vast population, but they're not as wealthy as the United States. The broadband connections are not as good. So they've got to do very well there, and there's a lot of execution risk, I think.
And let's not forget that there are a lot of Netflix bears. The short interest, the number of shares that are sold short is close to 20%. And last time when they came out with their quarterly results, this stock got crushed. In other words, if it plays against them, the stock gets hit. But when the news is better than expected, it pushes it up more. That's just one part of the Netflix story that people need to be aware of, too.
It has been a very volatile stock.
Yeah.
And Kevin, when you're asking that question, that Barton, why do you ask that, though? Are you finding it hard to value these media stocks?
I would love that kind of valuation for something that I own. So I always want to understand what a growth stock investor thinks about when they're valuing Netflix at 65 times earnings. Is it because they think the company is going to continue to grow at 70% impact? So that's sort of the way. I always want to understand what a growth stock investor is thinking about.
But are there any media stocks out there that are attractive for you as a value investor?
Yeah, sure. So, and the other reason why I asked the question is I own Time Warner and I own Viacom, and clearly their relationship with Netflix is very important. So you're certainly always trying to understand the dynamics of a company that Time Warner and Viacom are using to stream.
Well, that's a good question. What's in it for Time Warner to perhaps allow for some wiggle room for Netflix to get into this deal and for them to get out when Jeff Bewkes has made some comments taking a few punches at Netflix in the past?
Well, I think for the premium networks, for HBO, the reason people are signing up for these networks today is the original content. It's True Blood. It's that type of programming. It's less and less the movies. I think the fit for family entertainment, with a network that has True Blood and this other content, it may not be as strong, as it would be on something like Netflix. So I think what they could gain potentially is more money to spend on content that might drive more subscribers for HBO. So it might end up being a win-win. if they can negotiate a deal to exit early.
Go ahead.
I was going to say, is that their answer to HBO? Is HBO to go? Is it?
Well, HBO to go is the answer. I mean, I think Netflix is in a great position right now because there's historically not been other streaming alternatives, but HBO Go is part of a new wave that's answering that, and HBO Go is a great application that I think gives you more reason to sign up for HBO. So you can buy a stock that, is 64 PE, a distributor that'll face more competition, or someone who owns content like Time Warner, which I recommend, which can benefit, from valuing this content in multiple ways. Time Warner doesn't have a Netflix deal, but they'll find, more reasons for people to sign up for HBO through internet delivery.
Barton, I mean, just quickly, when will you know that the price increases are doing well, that they're doing well for the company?
Well, we'll kind of listen very closely to what they say tonight. I mean, I think we'll hear that there has to be some churn offset. If there's anything other than some meaningful churn offset, then people are sticky and they're receptive to the service even with the price hike, which it'll be a key test. I'm a little bit more skeptical, I think, than many.
Okay, and thus, and many are skeptical, the 20% short on that stock.
Yeah.
Barton, thank you very much. Barton Crockett.